There is a story of Emperor Nero playing the violin as he watched Rome burn. I know the musical nerds will tell me it's not the violin, something else. It doesn't matter. What's important is that when Rome was burning, he was standing and doing nothing. And this is exactly how I see the Federal Reserve System today. As our portfolio is burning, the Federal Reserve System is not doing anything. And actually, we can say that the Federal Reserve System is the main reason why our portfolio is crashing today, and they will contribute to this crash. We should not expect them to come and save us. The reason is very simple. It's because of the mandate that the Federal Reserve has today, and also because where the market is. If you look at the market, how it has been doing since 2020, you will see that it's mostly because of the amount of money that the Federal Reserve System has put in the system. The amount of money they have put in the financial system, they have created so much liquidity, and now that they are removing this money, the market is expected to crash and is crashing. And we know that there is a saying that the economy is not the stock market. The stock market is not the economy. So what the Federal Reserve System wants to do right now with whatever they are doing is try to fight inflation and also not cause a severe recession. So this is what they are doing. As far as your portfolio is concerned, the Federal Reserve System doesn't care at all. In fact, the reason why the Federal Reserve System was created was to prevent inflation and to prevent unemployment. So that is the dual mandate of the Federal Reserve System. Compared to other central banks around the world, which usually have only one mandate, and other central banks around the world, they are not structured like the Federal Reserve System, the Fed. The Fed has a dual mandate. Number one is to fight inflation, and number two is to prevent unemployment. That is to keep the unemployment rate low. And they do that through the federal fund rate, what we call interest rates. Of course, in recent decades, it has not been so easy to control inflation and unemployment rate with only the interest rates, because interest rates have been so low that they have been forced to pump money into the system, that is quantitative easing. And everything peaked in 2020 when we had the pandemic. So what happened in 2020, what the Federal Reserve System did and did not really work, was the way that they were injecting money in the system. What was expected, what the government really wanted them to do, was to put money to people who are going to use them. That is, people who need money. In 2020, Mark Zuckerberg, Bill Gates, these people, they did not really need money. They did not need it. It's the people who lost their job because of the pandemic. Those people were the ones that needed the money. So what the Federal Reserve System was trying to achieve by injecting money in the system to bring money to these people. But the money, unfortunately, did not go to these people. The money went to the stock market, because they cannot come and give you money in your bank account. This is not how the Fed works. This is how the Treasury works. Actually, they gave those checks to people. But this has to go through Congress, and it takes time to go through Congress for them to approve this. While what the Federal Reserve System can do, they can just print money out of thin air. They can bypass the whole political system. This is exactly what they did, but it did not work in 2020. And even in 2008, you may say that the Federal Reserve System printing all that money to save the economy, it did not really bring the money to those people who needed it. So the government still had to take debt to give money to people. So why I'm telling you all of this is because you need to understand, when the money doesn't go to the right people, it creates other problems. One of those problems is inflating the stock market, and that's why in 2020 the stock market recovered so quickly, because those people who owned financial assets, they were given so much money and the stock market went up. And those people got richer, and creates populism, because when the rich get richer and the poor is not getting that rich, it always creates populism, which leads to political consequences, social consequences as well. So this is where we are today. And now the Federal Reserve System, they have to undo everything that they did in the past few decades. In other words, they have to raise interest rates in order to fight inflation, because we have inflation, and they have to lower their balance sheet. So they have to sell all these assets that they bought. It was mostly bonds. So when they are selling all these assets, you can see a crash in the bond market. You can also see a crash in the stock market, because whenever there is a crash in the bond market, it means many people will be forced to sell. And when there is a sell-off, it triggers more selling. Those people selling, they have to cover their position, and sometimes those people selling, if they have taken debt, they have to cover their positions, so they were going to sell their stocks as well. So that's why we are seeing a crash in the stock market. And if you look at recent data, the economy did quite well in the third quarter. So there is no reason for the Federal Reserve System to stop what they are doing, because one of the fears that the market had for the Federal Reserve System was that they were going to raise interest rates so fast, they were going to sell their assets so fast that it was going to cause a hard crash on the economy. But this is not happening right now the way things are. It's only when the economy is really affected, then we can expect that the Fed will stop what they are doing. So the Fed right now, they don't care about the market, they care only about the economy. And in a way, it is good, because if you think about it, the market was overvalued and it is still overvalued. Look at the CAPE ratio, it's still over 25, which is overvalued. You look at the PE ratio of the S&P 500, it's still overvalued. So the market in general, stocks in general, are still expensive. So the Federal Reserve System crashing the market is not that bad, because eventually it will create opportunities for us, for value investors. But what about the long-term effects? If the market is crashing, of course, eventually this leads to economic effects. Just think about it. The stock market is not useless. It has its function. This is where people make money. If, let's say, the stock market is crashing, those businesses, they will need money. Those businesses, they use the stock market, the bond market, to raise capital. So if there is a crash, it's going to be harder for businesses to raise money, to raise capital in the market, and it can be bad for the economy. They will have to fire people if they cannot raise capital, for example. We know there are many businesses that have stopped hiring people. Big businesses, I'm talking about Facebook, these businesses. So it can have effects in the economy over the long term. But it's not going to be that bad, I think, as people are expecting. Why? Because companies were not over leveraged. It's not like in 2008. In 2008, companies were over leveraged. Even in 2000, during the dot-com bubble, those companies had so much debt, they were over leveraged. Of course, if everything crashes, the market crashes, these companies will go bankrupt, and all these bad debt just disappear. It causes effects into the banking system too. But not this time, because you look at the debt that companies have. Those big companies, they don't have much debt at all. Facebook only recently took a $10 billion debt. Apple, they have such a good balance sheet. Amazon, good balance sheet. Google. So it's not like in 2000 where the largest companies in the world had a lot of debt and then they were going bankrupt, like Enron. Or it's not like 2008 where the largest banks in the world had a lot of bad assets on the balance sheet and they were going bankrupt. It's not the same thing. So this time, if we see a market crash, it may not have such a severe effect into the economy. And that's another reason why I believe you should smash the like button to spread this video throughout the YouTube universe. That's another reason why I believe that a market crash is something that the Fed is not worried about. They are worried about many things, about inflation, about stagflation, but they are not worried about the market crash. They are not worried about your portfolio. But the Fed cannot also raise interest rates too much because of government debt. If they raise interest rate, the interest that the government will pay on its debt is going to be so high. So as long as the Fed can lower inflation to a reasonable amount, they are not going to bring it back to 2% over the long term. So let's say they can bring inflation to 3%. I think then they will stop with the quantitative tightening and they will stop with raising interest rates. If we see a recession, of course, this changes everything. And I'm talking about the real recession where you see people losing jobs. So if we see something like this happening, then maybe the Fed will just change what they are doing. But so far, I don't see this happening, and I don't think that the Fed has good enough reasons to stop the tightening policy. They have to continue it because things have got out of control. They are just returning to normal. But over the long term, as I told you, it can have effects on the market too, and eventually on the economy. And it's mainly because of government debt and also because of pensions. Because there are many people who have invested in, let's say, the S&P 500 thinking that they will retire with this. And if everything is crashes, they lose their money. And this have repercussions in the economy and also in politics. Because if you look at your pension, you're losing money. During the Biden administration, even though maybe he's not 100% at fault, you're going to blame him. So it has political repercussions as well. So what you should do, you as a value investor, you should ignore all of this. Don't try to fight the Fed. If the Fed says they are going to raise interest rates, don't invest in such a way that you expect interest rates to fall. Don't fight the Fed. What they say, probably they're going to do it. Even if they change course, which they have done so many times, then you have to change course, because the Fed has so much power in the market that it's impossible for you to try to fight them. So don't try to fight them. What you need to do is try to stay away from the market itself. Don't invest in companies that are following the S&P 500. Look for smaller companies that have low correlation with the market and with each other. So deep value investing is something that I would recommend you do today, or even at least value investing. Always look at the fundamentals, because fundamentals, this is what matters the most. Just giving you an example, something I read a few days ago. It's not about a US company, it's about Alibaba, but we can apply this to US companies as well. Alibaba bonds are doing pretty well this year, but the stocks are down. So why this is the case? It's because the bonds, they are valued based on cash flow. Nobody is worried that Alibaba will run out of money and they will not be able to pay their debt. Nobody is worried about it because they have the cash flow. They are here. But it's the same thing about stocks. But the market, the stock market is more volatile compared to the bond market. But you as a value investor, fundamental investor, you know it is the same thing. Bonds or stocks, it's the same thing. If a company can repay their debt, the company is doing well, so the bond prices are going up. Most probably the stock price also, it should be correlated with this. So if you're wondering which stocks I'm currently buying, please watch this video. Have a nice day and goodbye.